Yo, what's up guys? Kataluk from Move Finance here, and today we're going to talk about bad psychological behavior in crypto trading and protective measures and strategies to combat these human weaknesses. Cryptocurrency trading appears to be one of the fastest growing markets in the world. The crypto market have reached a total market cap of $2 trillion as of August 2021. The price of Bitcoin, the leading crypto coin, has more than quadrupled in value since last year. It grew from $10,000 in September 2020 to $47,000 as of August 2021. With this growth, we also saw an increase in new retail investors and newcomers who might not understand how risky and volatile this market is. And as we have seen before with Dogecoin, a single tweet from Elon Musk can make the price of Dogecoin go to the moon on crash. The second issue is volatility. Volatility is a measure of how much this market's overall value fluctuates up and down. Even dominant coins like Bitcoin fluctuates heavily. From May 10 to May 19, 2021, its price dropped from $55,000 to $37,000. Meanwhile, altcoins often display even more extreme price movements. This creates trading opportunities, but also make them high risk. There's many similarities with crypto trading and gambling, which means we can use the existing insights and psychological behaviors in gambling and day trading and apply it to crypto trading. Here is some of the most important psychological principles that are central to understanding the potentially addictive elements for this new behavior. Risk factors in cryptocurrency trading. The illusion of control. Crypto trading, as with day trading and sports betting, is not entirely based on chance. Skill and strategy can make a difference to outcomes. For example, buying an NFT after Logan Paul tweets about it is a terrible idea. By contrast, buying Bitcoin or some very proven to be useful altcoin after a sell-off is a really good idea. So you see, most sellers sell because of some dumb events and underprice the asset, giving us good deals. However, here is when the illusion of control hits. This effect is likely to be reinforced by biases, including self-serving attributions, which are outcomes who the trader thinks is due to personal action rather than external factors. Hindsight bias, which is when the outcome is seen as being hypothesized all along, and the hot hand fallacy, which is perceptions of predictable momentum shifts or winning periods. Many of these effects are likely to be strong in bull markets. If all the market does is go up, it becomes very easy to make money whatever you do. Bitcoin kind of acts like an index to the crypto market. So if Bitcoin experiences some growth, then there is a good chance altcoins will experience the same growth as well. Most investors' decisions and trades are likely going to be positively reinforced. As a result, investors may gain a false sense of invincibility and confidence that they can't be wrong. The market only goes up, right? So they start using more leverage, move capital from a more balanced portfolio to more speculative altcoins, and make absolutely no exit strategy. Social learning and reinforcement. Crypto has emerged around the same time of social media and is very popular on there, especially on platforms like Twitter and YouTube. Now the problem with that is that you can find at least one positive endorsement of at least one major coin, making everything look good. Whenever an influencer talks about a certain coin, pumps up in price, and whoever buys the pump loses a lot of money. And some influencers even get paid to talk about some coins, which is super fucked up. And now obviously there are some trusted sources on these websites, and Coinburu and Michael Vanderpool. Lex Fridman also brings amazing people on his podcast in this space, but the majority are ill-informed and everything should be taken with caution. The influencer, that is. Promotion is the worst resource to educate oneself on an investment. Now, FOMO, or fear of missing out, is one of the most common psychological effects when it comes to crypto trading, and it's really important not to fall into this trap. Now, FOMO does appear in other stuff like sports betting and day trading, but the thing is, in crypto trading, the market is always open, unlike the stock market or sports betting, because in sports betting, you have to wait for the next race, and in the stock market, you have to wait till the market opens in daylight hours. And for that reason, FOMO in the crypto markets is intensified. When traders look at all these altcoins 10xing in value, some might regret not making an investment or a larger investment, and worst of all, buy in right after a 10x pump only to see that investment fall to the trash and become a bag holder. Another big FOMO issue is not having an exit strategy or taking profits. You make an investment, you watch it 10x, and then you hold onto it thinking it might 20x or something. Then we got anticipated regrets. Many studies in cognitive psychology shows that doing something usually leads to stronger feelings of regret than not doing something. This explains why people explains why people are reluctant to sell their shares or coins and tweet diamond hands on Twitter. Now there's two terms for this: action of commission, which means doing something, and acts of omission, which means not doing anything. Acts of commission involving regrets in trading would include decisions where a stock or coin holding is sold only for it to rapidly appreciate in value. Acts of omission involve situations where ultimately successful stocks or coins were forgone, not purchased, for other investment decisions. Now both of these acts are likely to cause significant regrets in trading, and probably more than in gambling, because in gambling the games are usually of a short duration, and decisions made in one game have no bearing on outcomes of future games. So by contrast, crypto trading allows traders to observe the folly of the decisions over a long period of time, what they missed out on, the coin that has 100x in value in 6 months, and what coins they sold too early. Protective factors and strategies. Now that we have talked about unwanted psychological behaviors in the world of crypto trading, let's talk about some strategies to protect ourselves from these human weaknesses. First strategy is to set a budget. I keep 10% of my speculation fund and that's it. I rebalance the portfolio when the position grows more than 10%. Secondly, don't chase losses just so you could get a tax write-off. Remove all illusions of control and understand the influence Bitcoin have on the market. So if Bitcoin isn't doing well, altcoins are going to raise in value. Not unless investors think Bitcoin is stable, good altcoins projects get recognition. Focus on risk management and especially reducing downside risk. Reducing downside risk in crypto proved challenging, at least compared to the stock market. The best thing to do is to have an exiting strategy, convert to USD stable coins. Don't do research on YouTube, but use reliable sources and be skeptical. Don't get preoccupied studying price movements in the markets. A psychological factor called update checking, famously milked by Facebook, is to be aware of. Like people who always check their Instagram, new investors start checking the prices of their investment frequently in an unhealthy way. Strategies for dealing with this temptation might involve setting limits or rules on when or how often the prices are checked. Other activities might be scheduled ahead of price monitoring so that checking prices only occurs as a type of reward for completing other work. And finally, for dealing with FOMO, it's best to focus on positive outcomes instead of negative outcomes. Even experienced traders won't always buy at the lowest price or buy all the good coins. So just buy the dips and focus on reducing downsides. And that was it for this video, and thank you for smashing that like button. I appreciate that.